Our investors pay us a 3% management fee and 30% of their profits, and you want me to tell them we're buying some Apple?
Sorry, X.
Let's talk about finance lessons from the second episode of Billions based on my work experience at Goldman Sachs and my work experience at the top hedge funds in the world. Be sure to stick around until the end of this video as I grade the episode for Wall Street realism with a buy, hold, or sell rating. So how do hedge funds prepare to make money before the market opens? The answer is they have a morning meeting. Let's check it out.
We are up 32% year to date, and we are open to all money-making ideas. Longs, shorts, sells, covers, all alpha welcome.
Now, during the morning meeting, the portfolio manager, Bobby Axelrod, and his sidekick, Wags, what they do is they ask the other portfolio managers and analysts sitting at the table here to pitch their best money-making ideas. Yes, they're very rude with their employees, but the employees don't really care, as you can make 7 or 8 figures per year, although it's hell, and you do age a lot in that year. Now, each person at this table is responsible for investment ideas in stocks in different sectors, like technology stocks, but not Apple on the long side, which I'll explain why later on in this video. And the analysts and the portfolio managers at this table are also responsible for other sectors like retail stocks, industrials, banks, commodities, and healthcare stocks as well.
Why are we still tied up in those hospitals?
Baby boomers, they're getting old, so they're getting sick. When the group reports patient volumes, it's going to overshoot street expectations.
So when she says street expectations, she means that the company's quarterly revenue and earnings results will beat what the average Wall Street analyst is expecting, which means the stock will likely go up. And the way it works is, on average, if a company beats earnings expectations by, say, X%, then the stock will go up X%. So if this company beats earnings expectations by 10%, then the stock will also go up 10%. And the reason this is often the case is because analysts have target prices based on their future expectations of earnings and based on their target price, which is often based on a price to earnings multiple. So if an analyst thinks the target price of a stock is based on, say, 20 times their annual earnings estimate of $1, meaning 20 times earnings, and if a stock beats by 10%, for example, then the analyst's annual earnings estimate might jump by 10% to $1.10 in earnings per share. And if that analyst still assumes a target price based on 20 times earnings, then if earnings go from $1 to $1.10, then using a 20 times PE multiple results in the analyst's target price to go up from 20 times $1 to 20 times $1.10, which means 10% upside from $20 to a target price of $22.
Our investors pay us a 3% management fee and 30% of their profits, and you want me to tell them we're buying some Apple?
Sorry, X.
Accurate. As crazy as this sounds, pitching Apple as a long idea over the past 10 or so years is really frowned upon by sophisticated billionaire hedge fund owners, even though the trade made people a fortune. And the reason is that everyone has loved Apple for the past 10 or so years, and it's an easy stock to pitch as a long. And these analysts and portfolio managers are paid to search for investment ideas that are not as obvious. Now, if he pitched Apple as a short idea because of a thesis that Apple is potentially having supply or inventory issues or riots in China, and it's over-owned with a market cap of way over $2 trillion, and the stock won't go up on positive news, then Bobby Axelrod would respect that much more. And you'll notice here that Axelrod said, our investors pay a 3 and 30% fee. Now, what he means by this is that hedge funds get paid in 2 different ways. One is based on an annual management fee. So the annual management fee that Axe charges is 3%, meaning if he manages $1 billion, he gets 3% of $1 billion, which is $30 million as an annual fee to pay for salaries, travel, and back office, etc. The second way hedge funds make money is from the annual performance fee, which is 30% for Axe. So if his $1 billion fund is up 100% in a year from $1 billion to $2 billion, then his annual performance fee is 30% of the $1 billion in profits, which is $300 million. That's a lot. So that explains the 3 and 30% fees. The reality is, though, that most hedge funds charge a 1.5% annual management fee and a 20% annual incentive fee. Now, if you make investors a fortune, you can charge a higher fee, like 3 and 30%. It's rare. Now, if a hedge fund loses money in a year, they can't make that performance fee the next year until they make that money back for their investors. And this is called a high watermark. Now, longs are always much easier than shorts.
What happened on Eureka Transship? You knew they were going to whiff their numbers. Why didn't you bang the short harder? You left 5% on the table.
I thought they were gonna whiff, but I didn't know.
With a long idea, the most you can lose is 100% if, God forbid, the stock goes to zero. On the other hand, with a short idea, which means betting a stock will go down, it can theoretically go up a near infinite amount, and so your losses can be massive, which is why it's so hard to have conviction when deciding how big of a short position you should have. And we all saw what happened with GameStop as well as AMC.
Phones down. We're SEC compliance. I need all portfolio managers and analysts to return to their desks. Traders, stay here.
Every hedge fund's worst nightmare is an investigation by the Securities and Exchange Commission, or the SEC. Now, the SEC works closely with the FBI when investigating and then arresting insider traders. And the way it works is if you hear something that has not been publicly disclosed to the entire world over the internet by a publicly traded company, and you trade on this, or you tell anyone that trades on this information, then you can go to jail.
Case officers will meet each pod and expect full cooperation.
Better answer their questions. Cooperate.
Now, if you think long-term when investing, and you really focus on the fundamentals and valuation before the technical analysis, then you will likely make money in the long run. And this is something I teach in my online MBA degree programs. There are no shortcuts, and trading based on rumors can be thought of as insider trading and insider information by the regulators.
But going through your reports, I see gaps, like this boardwalk pipeline move. What supported it?
It was an event-driven strategy. Okay, it was based on an unsolicited tip.
Now, an event-driven strategy is when you invest based on a massive catalyst, like an acquisition, where you go long, meaning you buy the company being acquired, and then you go short the company making the acquisition. And the best way to explain this is to use an example. Let's say that Oracle, ticker ORCL, wants to buy Salesforce, ticker CRM, for the usual 30% premium on an acquisition. CRM will likely go up less than 30% though, unless investors think other companies like Microsoft might buy CRM. So let's say that CRM goes up 25% on the news, but not 30%. Okay, it goes up less than 30% because some event-driven hedge fund investors think the deal won't be approved by the government for competitive reasons, and also because the deal might take at least 6 months to close, and hence you can make interest on the money that you put in the bank or elsewhere for the next 6 months. So if an event-driven strategy-based hedge fund thinks the deal will go through, then they will go long ticker CRM after it's up 25%, and they will go short Oracle, which might need to raise debt or issue more shares, which is dilutive in order to do the deal. Then the event-driven fund levers up a lot, meaning they borrow money on margin to go short Oracle and long CRM. Then they make a fortune if the deal goes through, and if it does, the stock closes the 25 to 30% upside gap. Now, if it does not go through, then the hedge fund is in big trouble unless they use options as insurance financial instruments to protect this event-driven deal.
This Verizon trade?
It's part of an event-driven macro play. All right, I got a tip.
You're always innocent until proven guilty, of course. So if you're questioned, make sure you have your lawyer and not the firm's lawyer present.
Lawyer.
Your boss said you should cooperate.
Oh, lawyer.
Whatever you do, be polite, of course, or your boss will fire you with a generous severance if they are corrupt. Or if you're not polite, the SEC is more likely to come after you like they did with Martha Stewart when she was not polite when she was investigated, and subsequently she went to jail for insider trading.
You answer me one. How much do you make?
Now, if you are the on-site psychiatrist, which many top hedge funds have, then you might not have to cooperate fully with the SEC when it comes to patient-doctor confidentiality.
My files are confidential. You're not seeing them. You can call the Attorney General if you want, and tell her I say hi if you do. We had dinner last month. Otherwise...
Now, in real life before, she actually used to work at a hedge fund. And when she was actually preparing for this role, Tony Robbins coached her on how to be mentally prepared and aggressive. Now, hedge funds won't hire you if you don't sound confident, as confidence actually leads to perceived competence. It is what it is.
I hope you enjoyed the lifeboat drill this morning. We did not do well. In fact, we sank.
This is not accurate. No hedge fund would do a misleading drill like this, as it would destroy morale and lead to ethics issues. Now, the reality is that hedge funds have compliance departments, and often these compliance officers used to work for the SEC, but now they're obviously making much more. And their jobs is to monitor every single trade and due diligence process to make sure that no insider trading occurs.
How the hell are we supposed to make any money?
You think this is a joke, Victor?
Years ago, many hedge fund employees would react just like Victor did here. Now, the system was rigged for years, and hedge funds got away with insider information as politicians received massive campaign contributions from some big hedge funds. And Axelrod is about to make an example out of Victor. Let's check it out here.
We're lucky the SEC hasn't come calling already. You're done. Fired.
This is not accurate. Now, given how much insider information Axe likely knew about Victor's many trades, he would not fire and humiliate him like this in front of everybody. Now, at top hedge funds, people notice that an email bounces, and that is how they learn that somebody has been let go. And the person let go is fired in a more dignified way with a generous severance, and often with a 1-year period where they don't get part of their bonus if they rock the boat when they leave. Plus, if they go after their boss that fired them, then they probably won't get hired for another job at another good hedge fund. Let's pivot now and chat about what scares investors in hedge funds and when investing in icons like Elon Musk.
I don't bet on long shots when it comes to investing the pensions of my members. That's why they trust me with their $5 billion. I get nervous. I see someone like Axelrod running around spending his money like he's a damn rap singer.
Here we have a massive investor in Axelrod's hedge fund, and he's very nervous because Bobby Axelrod bought a mansion, and investors hate it when hedge fund managers or CEOs get distracted when they buy a sports team, or when they spend too much time on pet projects like Elon buying Twitter, or Jack Dorsey, the founder of Twitter, having new hobbies which hurt Twitter's growth a few years ago. Now, I know people in the hedge fund industry that short stocks when CEOs or founders buy a sports team, or they get distracted with a big hobby. Let's now talk about what usually happens when the SEC goes after a hedge fund on a valid insider information claim.
So settlement or trial?
We're prepared to fight this for as long as we...
I came here today to take a deal.
This is accurate. Most hedge funds settle with a big fine, and then they exit the hedge fund business for life, and they start a family office to manage just their own money. All right, let's talk about grading of this episode for Wall Street Realism with a buy, hold, or sell rating. Now, the scenes about the morning meeting are incredibly accurate. However, the pretend SEC investigation is great drama and dialogue, but it's not something you would see, as it could lead to a rumor on the street that Axe Capital is corrupt, and as a result, I'm going to give this episode number 2 here a hold rating. Please like, comment, and subscribe, and I will see you soon in our next reaction video when we react to episode 3. Thank you.